Hello and welcome, and thank you for joining us for another roundtable in our series that's running all this week on ESG Clarity. I'm the Global Deputy Editor, Natasha Turner, and today I'm delighted to be joined by an esteemed panel for what I hope will be a lively, informative, and above all, poignant discussion about human rights and investment. This roundtable series is running throughout COP27, so it would really be remiss not to include a conversation about human rights in this series, which should be really front and center of people's minds during these important negotiations. So before we get into these conversations about how the investment industry can be tackling human rights concerns, let's just get a sense of what some of the most pressing issues are right now that are actually realistic for investors to be able to impact and to address.
It's Aine, Clarke, and I'm the head of KnowTheChain and investor strategy for the Business and Human Rights Resource Centre. For us, we see that with the transition from kind of peak pandemic to new normal, the long existing inequalities have been, within global supply chains and business practices have been exacerbated by COVID-19. And this has meant severe consequences for already vulnerable workers, including women and migrant workers. And then new converging crises like global conflict and the cost of living surges, inflation and growing social tensions further threaten to undermine labour rights across these global supply chains. And kind of high-risk sectors include, the garment sector, where both the demand side as markets in the global north contract and the supply side as producing countries face national crises. These are illustrative of, contexts like Myanmar, Sri Lanka, and Pakistan that are going through these kind of changes. And so we, are acutely aware of the closing of civic space in particular regions as well, and how that and how businesses are reacting to that in terms of kind of their own freedom of association and collective bargaining practices. And so we see, these enabling rights as key issues for investors as we go forward.
In your work, Paloma, I mean, you've highlighted some of these issues, right? And you have also found, you've, as you say, you've found them like across sectors, and you found them, to be issues for many managers and asset owners. And you've also found in some of your work that they're not being addressed, right? So why are these being overlooked? Why are human rights proposals often voted against, even by firms that are supposedly looking at these things? Why is that shift to a different kind of investing, as you talk about, not happening?
Hi everyone, and thanks Natasha for inviting me. My name is Paloma Muñoz. I lead the BSR's work at the intersection of human rights and financial services. And that means that I advise a wide range of financial actors, including asset owners and managers across asset classes, on human rights, on how to embed human rights into their investment practices, and so on. I think that's a great question. I would, maybe I would just start by saying that there's movement. There is movement in the right direction, in my opinion. So I think traditionally there has been far less attention to human rights issues and human rights approaches, and the core reason for that is that there has traditionally been a lack of understanding amongst institutional investors regarding what human rights standards are, and then how they relate to ESG investing. And by saying that, I mean both in terms of what do we mean by human rights, right? Because I think there's an issue around sort of the narrow definition of human rights that exists. Maybe it's modern slavery, or maybe it's some sort of supply chain issue or DEI, and not an appreciation of the fact that human rights cut across all civil, political, economic, social, cultural, labor, and environmental rights. I mean, we're talking about a lot of issues. And so I think one is just like a lack of familiarity of what human rights are, perhaps. And then secondly, about what a human rights approach means. How do you assess risk to people? What is the methodology that you would use? And I think there are many reasons for that, right? I think that it's taken the community, the business and human rights community, which I work in and from, quite some time to elaborate on the standards. How do you unpack the UN guiding principles on business and human rights for institutional investors? The OECD has done a good job. In 2017, they put out some guidance on that. But more practice, more examples, more everything is needed to help investors really kind of make that shift. And it's taken a while also for regulatory frameworks and other sort of drivers to align to the human rights-based approach. But again, I think that's also changing. Obviously, Europe taking the lead by, for example, integrating human rights standards into the sustainable finance disclosure requirements, forthcoming due diligence regulation. I think all of these things are going to contribute to seeing, you'll see an uptick of investor engagement on human rights. And I think there are many other reasons as well, but I'll leave it at that for now.
Neil Brown, head of equities at GIB, taking the positive from the advances that we have made. I think where we've worked well, it has been this financial case, it has been the business case, and quite often the taxonomy is largely looking at business revenues, products, services, how they make their money. And a lot of these issues, rightly or wrongly, are viewed as below the line. And when investors look below the revenue line, they start to talk about cost and risk, and that has less of a driver behind it. So I think we have two things happening. One is we're getting much better at making the business case. So a lot of the engagement I've done has been around apparel, and I think we're making the case that a loss of trust from the consumer does translate to an impact on sales, to give it its most basic. And at the same time, investors are starting to ask much deeper questions about being in the service of the end client, the world that they want to inhabit and live in, beyond financial returns. I think the financial returns are still there and they're still paramount, but I think people are asking much more about the way the money is made, what other impacts can be had, what other benefits, what other value can the end client receive from these investments, and that should help to drive further improvements in these not below the line issues, but operational conduct, behavior aspects.
Mm-hmm. So, I mean, yeah, you've mentioned sort of financial and kind of social risks. I suppose are there other things that come into consideration that people are asking about? Reputational risks? Are there other things that can help your case, I suppose?
Yeah, and we've touched on the taxonomy, principal adverse indicators. We are tightening up, we are aligning with the very brilliant. I mean, we're past 10 years, I think, from the guiding principles and from Ruggie. So, this has been a long, slow process. We're coming up on 10 years since the Rana Plaza, but I think you can't look back and say there hasn't been any development. I think we'd all agree we're not there, and we're sort of looking at that acceleration. As an investor, I will look for not just data and disclosure from companies, but the way it can be aggregated, the way it can be brought into thematic notes, the way that the research that I read incorporates this issue and says this is a better business for all of these issues, not it's a great business and we've also looked at these other aspects as a sort of hygiene on a recommendation, but really integrating these issues into understanding the full business case. I think improvements are coming. A social taxonomy will be great should it arrive. Not easy, but neither was the initial taxonomy until we got started.
I'm Chris Welsford. I'm the managing director of Ayres Punchard. We engage in research into sustainability and impact issues for our own portfolio. We do very deep dive research, and then we issue reports which we use to engage with fund managers. One of the things that is absolutely clear when we go back and engage with fund managers is that we can engage on environmental issues, can engage on anti-corruption. As soon as we start moving into human rights and labor rights, it becomes less easy. And that's why this is such an interesting debate, because there's a disjunct between what we see as a threat and what we perceive as a threat and what actually is a threat in terms of risk within our portfolios. And when we come to talk about labour rights, it tends to not focus on the human beings, the individuals, because we can't imagine a factory in Mexico, for instance. We're having a discussion in London. The factory in Mexico, these people are completely not joined to us. You know, we can't have, well, I personally can feel it, but I know that when I'm talking to people, it's difficult for them to have empathy with the working conditions, say, or the fact they're earning 25% of what sustainable living wage would be in that country, and that we've ended up invested in a company that's doing that, and we're having to talk about it. In a way, we'd rather ignore it, and I think the real beauty of what we're talking about today and the research that's been done is that it does make a difference, and it does create significant risk within the portfolio. And I just think that that's kind of, it's almost because it's a global issue, it's such a big issue, it's difficult to reduce it down into terms that we can understand.
In terms of the compartmentalization that you mentioned, I mean, I think it's in a way it's needed so that, you know, we feel like we can tackle and measure these issues. But I mean, the ESG framing, I think, is counterproductive in the sense that it splits the human element of business from the environmental element, right? And so this is why we get divergent theories and methodologies and categorizations of S and what it means. So, you know, what we have at the moment is that we feel like everything to do with people kind of falls under the S, when in reality impacts on people can be social, environmental, or economic in nature. And I think we see that within the renewable energy sector in particular. Is a focus of the resource center, where, you know, renewable energy companies are vital to ensuring the transition to a low carbon economy. However, oftentimes they enact the same exploitative models as fossil fuel companies have done, and also, you know, even more so, you know, gig economy workers as well, in terms of their temporary contracts and the lack of security that they provide for their own workers. Not to mention, you know, issues of land rights and free, prior and informed consent. And so, you know, you have a situation whereby, you know, renewable energy companies with, you know, which produce less greenhouse gas emissions are, you know, deemed to be good or better, when in reality sometimes they can be similarly exploitative. And you know, going back to Paloma's point, I think, you know, the UNGP framework is so vital and important because it's you know, the responsibility of the entity under the framework entails taking reasonable steps to kind of understand how people may be affected by a company's operations and through its value chains, mitigate those risks, and then provide remedy to people whose human rights have been infringed, and kind of reinstating that basic dignity, people's basic dignity and equality. So I think that's a helpful framing to bear in mind.
Thanks, and we covered the Business and Human Rights Resource Centre's guide on that issue in renewables on ESG Clarity this week, actually. And, you know, I mean, when you're kind of engaging with, you know, so the global firms that you engage with, Anya, what are you finding the reception like? And is it the case that if you were looking for a climate solution, like investing in a renewable company, and then you find some of these issues coming up, you know, that must be quite a tricky thing to navigate. So is it to use some of these frameworks that you're suggesting, or what would you tend to find when you're engaging with companies on that?
Generally, we will, you know, if there's an allegation that comes up against a company, which we collect, we will then seek a response from the company as to kind of what they're doing about the allegation, and how they're seeking to resolve it. In many cases, you know, companies' responses vary, you know, and some of them are very responsive and engaged with the allegation, and will look to conduct appropriate due diligence. Quite often we find that companies respond to our request and not mention the allegation at all, and so just redirect us to their human rights human rights policy, if there is one, or a code of conduct or something like that. And then in other cases, we don't get a response.
The problem is often for us when we're engaging with fund managers is that the engagement takes the form of reassurances and basically just checking with the company and getting the process thrown back. This is what our procedures are. This is how we do it. But what we really want fund managers to be doing is to be digging much deeper and not taking companies' word for it, because ultimately sometimes that is where it stops, and that just isn't enough. And we will always in our arguments make evidenced arguments about what's been going on, what other people have been saying about that organisation, and what evidence there is for those claims. We're looking a lot more down the information chain, if you like, to be able to say this is what happened. It's not good enough for the company just to deny it, which is very much what Aine was saying. It's got to be, you've got to be more acute with it. And if you don't do that, then you're just basically potentially swallowing the lies that you're being told. And we don't think that's good enough. So and also I suppose that the point about that is that it's not just a question of being lied to. It's also a question of why are you doing this in the first place? What is the point? If you believe that these principles of sustainability are important, and you make a lot of claims about positive impact, then you've got to take into account the negative impacts too. So the transgressions of the principles, not just the times when the principles are being obeyed. And the UN's very clear when we read the background notes to the principles. It's very, very clear. They don't expect there to be a balancing act, but all the time we're being told, well, it's a matter of balance. It's a matter of have to give a little bit on this side and take a little bit on that side, and frankly that isn't good enough.
Neil, did you want to speak to the kind of robust engagement process on these from your perspective?
Yes, I very much welcome the idea that interrogation of fund managers can be more robust. I think it should be. People, I'm sure, will answer these questions to a degree of depth, and the harder that people push, the better. Good fund managers should welcome it, of course. These are challenging issues, but it's obvious sometimes in the discussion that we can get the confidence that we need. We can see the weakness in the data. We can understand what we need to go out and request from companies and cross-reference and speak to NGOs and civil society. And that questioning in itself, I think, pushes people on.
I just wanted to add another important driver here that I think is relevant for this particular part of the discussion. And I think over the last 10 years, we've seen sort of the growth of benchmarks that benchmark companies. KnowTheChain, I think, is a great example. I mean, these are all great tools for investors to use. In different degrees, they're more or less helpful to understand what the real world impacts of portfolio companies are, but still they're useful tools. But I would say that one big change that I'm seeing right now that can really help improve how asset managers and owners really engage on human rights issues is also the emergence of benchmarks of human rights benchmarks of financial institutions, right? And so for that reason, really want to call out the World Benchmarking Alliance's new benchmark that's looking at the financial system. This year they're looking at 400 financial services companies, the 400 biggest institutions in the world, to evaluate them. How are they doing on managing risk to people and the environment, right? And so those are very much those indicators, and what they're evaluating institutions on is on their alignment with the UN guiding principles. And it cuts across asset classes, right? So it's not just sort of banks, and it's not just public equity firms, it's actually private equity, which is also an asset class and an investment space that I think is especially lagging when it comes to human rights, which I think is great. And it's really starting to raise a lot of questions amongst institutions that have been, I've found in the past, rather quiet and more focused on environmental issues, for example. So I don't know. I think as we think about the drivers here, that's also an important development that I thought would be worth flagging.
Then sort of brings us into talking a bit more about the practical side of things going forward and how investors can be starting to consider this. And with Anya on the panel here, it'd be a great opportunity to talk a bit more about KnowTheChain and how it can be used actually.
I guess and thanks Paloma for the plug. So I guess just going back and looking at the overall kind of theory of change, kind of benchmark seeks to tap into the competitive market and create this race to the top by publicly scoring companies visiting their peers. And so we identify and call out kind of good practice and bad practice. And that can obviously generate reputational benefits and challenges for companies, and then create incentives for investors, for example, or wider stakeholders like civil society organizations to act on specific issues. Frameworks, there's variations in methodologies, but frameworks like KnowTheChain and the CHRB, WBA, they are aligned with the UNGPs, and KnowTheChain, which is focused on forced labor within and labor rights risks and impacts within the supply chain. It seeks to drive both better disclosure and better practice, because disclosure in and of itself is not going to create change and improve outcomes for workers on the ground. How would we like to see investors using the benchmark? I mean, as I said, we identify areas of good practice and bad practice. So while it's not an exact science, it's very clear from the evidence that we produce which companies are performing well and which companies are underperforming or could be doing a lot better. And so that gives a yardstick for investors, who are invariably invested in these companies, because our target company list is, market capitalization, that, some of the larger players in the space are not doing well on specific issues. And then, it is up to the investor to incorporate, but first of all, incorporate the findings or the methodology within their investment analysis, stewardship, and/or decision making more generally. And stewardship, we have found, and stewardship and voting and engagement, as Neil mentioned, is a hugely important part of that. So using the evidence base that we provide to have those more difficult conversations with companies, and then drive those improvements, based on the various different the input from stakeholders, and of course the framework of the UNGPs, really understand kind of what good practice is, and then driving that change.
Chris and Neil, as well as sort of frameworks and benchmarks and these things, and engagement practices, what other things could help you facilitate taking some of these things into account? Is there regulation you'd like to see that could help in this area? What's on your wish list, I suppose, for kind of making your jobs easier?
It's difficult. Regulation, I think we've got the regulations already, well, certainly in the UK. The problem is enforcement. That doesn't seem to happen.
An investor, so we make demands, more of everything, faster, verified, audited material. But I said already, the social taxonomy, I don't want to see that stalled, acknowledging the difficulties there. I think if I look at the gains we've made, they have been data-led. The PRI has actually done a report on engagement with palm oil that we're involved in. That used the spot tool, really powerful. Higg index in apparel, transparency index from Fashion Revolution. These things are very, very powerful. We've talked about the renewable energies and looking at the way these companies conduct themselves, as well as what they do, which is extremely important, and benchmarking. So that more of that. However, it needs to get into the investment pipe, if you like. It needs to get into the plumbing, and it's when, if we want a lot of capital to support these issues and to move to the companies that we think are making money by improving the world, then we need this to fit into the research machine. And so if we've got data out there that says this is a well-run company, people who evaluate whether these are good investments need to pick that up and run with it. We've seen big changes on the sell side, on investment banks. They have sustainability teams. They're doing great thematic work. It is frequently revenue thematic orientated just by the nature of investment. And I think the more that we can get this great data into that machinery, the better. All of that deals with financial materiality, and I think at the same time, a greater focus on impact, a greater focus on that greater value in what clients perceive with where their money has been put is also very powerful. But I think if we want the bulk of capital to move, that financial materiality piece is still really key.
I think that's a good point, and I would just flag that, definitely there are differences between regions, and I think that's important to also recognize. I think in Europe right now you have sort of a general consensus that ESG issues, human rights in particular, are indeed material. So the SFDR reflects that. The sort of due diligence directive obviously are going to turn that into a sort of technically legal requirement to recognize that as well. Now, that's not the case so much in the United States and in other regions. And so I do think that regulation, or at least governments taking steps to clarify that fiduciary duties include, the responsibility to pay attention to material human rights issues, that's just the minimum thing that needs to happen, right? So for example, in the United States, regulation from the SEC that calls for disclosure of, for example, environmental and human rights due diligence would be great. So that investors have access to the type of information that they need. And so I think that's one sort of low-hanging fruit. Politically, maybe not so easy, but I think it's a minimum. I also think, just to flag, a lot of the issues that we're talking about, human rights issues, are systemic issues, right? And, require systemic solutions, right? And so that's why you have seen a range of investors, particularly, from different regions, calling on governments to adopt mandatory human rights due diligence measures in their own operations. In my previous job as director of the Investor Alliance for Human Rights, we sent letters to the EU Parliament, to Congress, and everywhere to say, look, for us to really manage our, material human rights risks, we need companies to do their due diligence. And one great way would be for governments to require companies to conduct human rights due diligence, not just disclose. So again, going to the issue of disclosure regulation versus due diligence regulation, and I think both are important, right? So investors have spoken out about that. In fact, recently in the UK, there was a letter that went out, calling for the adoption of a similar mechanism law in the UK.
Just before we finish then, it would be great if we could kind of leave everyone on an action point to take away from this discussion from each of you, kind of one key point you think fund selectors particularly could take and take back to their organizations.
Well, we touched on the questioning, on the robust conversations. I think it's trying to understand not just what fund managers do, but I think we've touched on sort of the why are they doing it? Are they doing it to answer your questions, or are they doing it because they believe that there is financial value and impact value and value to the end clients in really grappling with these issues and getting the best understanding that they can? To coin the phrase that started me in all of this, better returns in a better world.
Chris, how about you?
The why is that we avoid social mayhem, civil unrest, because the ultimate result of serious human rights transgressions by largely Western and Northern Hemisphere companies, the rich world against the less well-off world, is that we will see that in terms of conflict, and we need to watch out, because that ultimately could be the result of ignoring this. And it's really encouraging that I can see that it's got a much better profile within our industry, and hopefully we can lead some proper change.
Anya, what would your one takeaway be for listeners?
Investment firms, fund managers should ask, just look for help. It's not something that has been within the traditional remit of of fund managers, and there are organizations out there who are measuring, who are educating on this issue. BSR is one of those that is doing wonderful work with investors on incorporating human rights, and yeah, so just ask and don't be afraid to ask the questions.
Paloma, then what's your main takeaway?
Maybe just also because I'm sitting in New York, I will say that right now ESG is really at a moment. It's having a moment for good and for bad, right? And there's increasing accusations of ESG being greenwashing, also increasing accusations of it as being biased, politically biased, particularly in the United States. And I think it's really time for ESG and investors investing in ESG to kind of show that it works, and it works for people. And that really, to me, means it's key for investors to start really taking a human rights-based approach that focuses on impacts on people, right? And I think this goes to the financial materiality piece. There is tremendous overlap between impacts on people and salient human rights issues, we would call them, and material financial risks. However, not always. And I think that's okay, because I think the other thing about the human rights-based approach is that even if the issue isn't material yet that you identify, it may become over time, right? Human rights risks that are small grow and grow and grow and have a way of becoming financially material. And so it's a useful framework even to foresee risks that are around the corner, even if they aren't material now. So yeah, that would be maybe my one takeaway for now.
And that actually brings us back to where this kind of roundtable started from, which was a discussion with you, Paloma, about using that human rights-based approach and spotting those risks earlier than ESG, that actually led to Chris getting in touch and so on. So it's really great to bring that background and to have this discussion with everyone today. So thank you very much for joining us.